So for the past 2 weeks, we talked about the money supply process and how Fed uses open market tools to change the money supply and leads to expansion or the contraction of the money supply. So I wanted to spend today to talk about the quiz since it's a quiz for 2 weeks. And it is important to review this because I actually have assigned some articles to read that have different time or dates on them. Then they're not current. They're current in the sense that in the past couple of years, but not as of this week or this month. And after each article, I have specific questions. The first one is asking, explain how the Fed, please explain how the Fed increases the money supply. And then please explain how or what Fed has been doing recently with respect to the money supply, right? So let's review the time frame of the recent post-COVID events with respect to the Federal Reserve and the monetary policy, and then fit these articles into that time frame. And then we'll talk about how Fed usually increases the money supply, and then how or what Fed has been doing recently with respect to the money supply, right? So this is the S&P 500, and I'm looking at it at trading view, and right here on early 2020, the first couple of months, we actually noticed what was going on in China, and as soon as we realized that this was going to be a global event, the market kind of crashed all the way till the end of March. Now, at that point, we had these hunkering down, the mask mandates, the vaccination came a little bit later. But the economy came to a standstill. And one of the significant worries was, like in these, days and weeks, the market circuit breaker was kicking in on a daily basis when the markets were crashing about 5-10% a day. So from that March of 2020 all the way till the January of 2022, Fed employed what they call a dovish monetary policy, in which they employed zero reserves, zero interest rates, zero Fed funds rate, zero discount rate. I mean, as zero as it gets, which simply created significant expansion in the monetary supply. Now, the timing again is we noticed it at the beginning of 2020, January and March, January till March. And then in March, we actually had the down point of the market. And from that March all the way till the December or beginning of 2022, we had the Fed employing the dovish monetary. So March 2020 till January 2022. So from that January 2022 all the way till October of 2022, Fed started to hike interest rates, and I think a little bit later than that too, or beginning of this year, and then continued a couple of hikes this year. And then up until recently, they've been actually very, very hawkish. So right around that level, Fed realized that the monetary expansion was causing an inflationary money supply, and that the price increases in the economy were not transitory and they were actually permanent. And even at the risk of causing a recession, they actually opted to increase interest rates just so that they could manage inflation and control it. And we've talked about how the inflation ran all the way up to 9% and double digits, and recently they actually were able to control that. So this week's quiz is not about just knowing everything that we talked about, but applying them. So the first article that I ask you to read is, and I can't show you the entire copyright issues, but it says the economist reply, how is this for proof on money supply and inflation? We used the tried and true quantitative theory of money and M2 to predict the year-over-year inflation rate. So, and this is July of 2022, right? So the July of 2022 goes right around here, right? So that article would be somewhere around here, right? So, and then the question is, how is the money supply and inflation, a problem, right? And then what I'm asking you to explain is how Fed increases the money supply. So it's a specific question to the time frame. The question really is, from this point all the way to this, what did Fed do to increase the money supply? So, we discussed about how to increase the money supply, and the question is basically asking for you to do a little bit of research as to find the monetary activity that the Fed employed immediately after COVID, and then from that point on, how did it affect the monetary supply, and how did it actually cause inflation? So just to give you a little bit of pointers, the idea was to keep interest rates as low as possible at 0%. And in fact, in Europe, right around that time, the monetary policy was to have a negative interest rate that would actually increase the monetary supply, and therefore keep also the reserves at zero, and that would increase money creation, that would increase the money supply, and that would actually allow the business activity to run a little bit hotter or faster than usual. So that's number one. And number two, which we talked about how these were all, they've tested this, but they're not doing this anymore. Open market tools, they are not in effect anymore. So let's take a look at those. And notice here that this is the Federal Reserve policy tools. They're called expired policy tools. And the first one was, for instance, the commercial paper funding facility. And notice how they implemented this in March of 2020, all the way till the March of 2021. So March of 2020 is right there. And then right at the bottom of that, and then all the way till right around this 2021. So it kind of ignited the market and started, gave it a jump, if you will. And then from that jump, it went to continue with a easy money policy. And the idea with the commercial paper funding facility was, like we discussed on Wednesday, to provide commercial paper markets or institutions that are not depository banks or depository institutions to have access to commercial paper, to be able to sell their bonds. And that allows excess money in the market, and that allows these companies to be able to borrow and to invest, and therefore have the business cycles running. And so that was one. The other one, obviously, was the primary market corporate credit facility, secondary market corporate facility, like we talked on Wednesday, term asset-backed securities loan, municipal liquidity loan, Main Street lending program, money market investor funding facility. Pretty much many of these were actually either implemented after 2008 and 2009 crisis, but many of them also were implemented right after COVID. So what are the, specifically, please, how, what Fed did to increase the money supply? Well, they actually lowered the interest rates as zero as possible, and without going into negative territory. They lowered two reserves to zero, which means that the banks had full access to deposits, and they didn't have to have any reserves that would restrict any further money creation, and therefore it was intended to have the full effect on the money expansion intentions of the Fed. And they also bought a commercial paper from the market, and they provided primary market funding to the market and secondary funding uh, to the market, which allows these corporate bonds to be on the balance sheet of the Fed, but the cash to be in the market, and that allows liquidity to be flooded into the market. And this liquidity creates a larger money supply because they turn into deposits. And because the reserves are zero, more deposits lead to more money creation, and more money creation leads to more deposits. And, it just starts that cycle of the monetary or money multiplier. And that leads to the economic monetary expansion. So the second one is, please explain what Fed has been doing recently with respect to the money supply. So the recently is this area right here, or I want to say that since this is the article that I'm asking, so anything after this period, where we are basically arguing that right around this January of 2022, Fed realized that what they were doing with the extreme money market expansion was not in favor of, economic health, meaning they realize that the inflation is not transitory, meaning that the inflation is not caused and by COVID and only to disappear after COVID. But whatever the reason that's causing the inflation, it's here to stay, and it has to be dealt with monetary policy. And as soon as they realized that, they changed their monetary policy to a hawkish, which means they started increasing interest rates. So the question is, what has Fed has been doing recently with respect to the money supply? So, and the answer to that would be that by increasing interest rates, but still keeping the reserves at zero, they restrict borrowing. And they also stopped the extra policy tools right around that mark cutoff. And this was actually, if you think about it, right around this article's a few months before this article. And so by stopping these facilities or letting them expire, the idea is that there is no more flooding the market with money, with liquidity, and in a way allowing these corporate bonds or secondary market bonds to replace money, and therefore suck the money out or dry the money out of the liquidity markets, and that would constrict the money supply. The analogy always we talk about is how like a paper towel. You have a little bit of water, you actually put the paper towel, and then you take the water out with that. So the paper, the commercial paper or treasuries or any sort of bond, literally replaces the cash or liquidity with paper, and therefore drains the market of liquidity. So by causing these facilities, Fed's intention was to lead to less liquidity in the market, more corporate bonds and treasuries in the market, almost like a reverse quantitative easing, and increase the interest rate so the borrowing would be lower, which led to significant, because you are literally letting the bonds back into the market, that lowers the price of bonds. You're creating the supply, increasing the supply of bonds, that it reduces the price of bonds, which increases the yields of bonds. And as the yields increase, that leads to less borrowing, less business activity, less business cycle, and therefore economic slowdown. And that also would constrict the money supply, because as people borrow less, there will be less money creation. Remember, when we talked about the money creation, there are four players in this. And the first one is the Fed, and then we have the deposit institutions, we have the depositors, you and I, and then we have the borrowers. So as the yields increase, the borrowers actually borrow less. And if they borrow less, then there is less money to be created. Because remember, for money creation, the first bank has the reserves, and then the security is replaced with reserves, and then they deposit this as a loan, and then the loan gets withdrawn, deposited to the second bank. That second bank gives a loan. That loan deposited, so on and so forth. So if there are less loans, the process actually stops at that point, or slows down. So we never have the full effect of the money multiplier and full effect of the money creation process. So that was one of the main issues, or main monetary tools that Fed employed, in which they simply increased interest rates, restricted borrowing, increased yields, and lowered bond prices. And as a consequence, we actually have significant many banks, Silicon Valley Bank, for instance, as an example, having trouble with their bond portfolio simply because their bond prices are lower, and therefore their bond portfolio value is lower, and then that this allows them to create more lending, create more funding for the market, and therefore that drains money out of the economy, so that constricts the money supply. So when Silicon Valley Bank, for instance, had trouble, one of the things that Fed said was, or the Fed chairman said, was that the banks having trouble with their lending, it serves the same purpose as increasing the interest rates, which is correct, because as you can see, the intention behind increasing interest rates is you want to slow down the money creation process, so the money not only expends but actually constricts. And with that, it's just, once you establish that, then you basically deal with the overexpansion of the market and overexpansion of prices and over increase of prices. So the same effect can also be achieved if the banks lend less money. That stops the money creation or slows it down, and therefore, while the economy is growing, there's less money to be borrowed, and that slows down the economy and has the same impact as increased interest rates. So at that point, I think the Fed stopped increasing interest rates, or I think they increased another 0.25%. But after that, that was it. So, that's the primary steps that the Fed took recently to shrink the money supply, that they have been inflating it for about a year after COVID. So was that a mistake to increase the money supply that much? That's a point of discussion. However, I like you to notice that whatever they were doing after COVID, they reversed it, and they stopped all these extra facilities that they stopped. And they reversed their monetary policy of flooding the market with money into flooding the market with commercial and treasury paper, and draining cash out of the economy, or draining liquidity out of the economy. So the second question is, this is gone. So the second question is, please read this article right here. So it says the Fed indirectly shrinks the money supply, actions reducing reserves tend to turn to induce banks to reduce lending. So this is August 2021. So let's put that on right here. So August 2021 is right around here, approximately, right? And the question is, Fed is indirectly shrinking the money supply. And this came around a time when they were actually actively increasing the money supply, and therefore inadvertently causing inflation. So the article is about shrinking the money supply in 2021. And now this is interesting. And the following, because we already said that they were actually increasing the money supply, but inadvertently with what they were doing, and that's really important that you read the article, that they were actually shrinking the money supply at the same time. So increase it with other tools, but shrinking it with other tools. So based on this article specifically, why was Fed shrinking the money supply? And then based on this article, how was Fed shrinking the money supply? So let's take a look at the first paragraph only, which allows us to read it without subscription. Fed's sale of $1 trillion of reverse repo. By the way, you can access Wall Street Journal through your Loyola single sign-on, and you can read the entire article. For the sake of this video, I just cannot show you the entire article, but to me, for my explanation purposes, the first paragraph kind of helps me now. So the Fed sale of $1 trillion of reverse repos does not, in and of itself, reduce the deposit liabilities of banks and money market mutual funds, and that the money supply is unaffected. By that logic, none of the monetary tools of Federal Reserve Bank would affect the money supply. So, and what I'm asking you to answer is why they were shrinking the money supply and how were they shrinking the money supply. So, and from this argument, the argument is that the Fed was employing a policy which was to, well, they were employing policies, including these after COVID, to increase the monetary supply. However, during that time, they have also sold $1 trillion of reverse repos to depository institutions. So if they sell $1 trillion of reverse repos, you are taking money out of banks' reserve accounts. That if so, what you're doing is you are selling $1 trillion of reverse repos, which means you're taking money out of their reserve accounts, which in a way leads to less lending, less deposits, less lending, and therefore it will have an impact of lowering the money creation and therefore either slowing down the expansion of the economy or to the shrinking of the monetary supply. So why was it that the Fed was buying all these reverse repos, and that why do they argue that this does not change the deposit liabilities of the banks? And obviously, by that logic, none of the monetary tools that we talked about with respect to the money supply process would actually affect money supply. If Fed's argument is that the reverse repos do not reduce the deposit liabilities, then none of them actually should have an impact. So it is a rather interesting point. If Fed is arguing that the reverse repo does not change the monetary supply, then none of the monetary supply tools should also or should not also have any effect. So in a way, I think that they were right, because at around that time, they actually lowered the reserves down to zero. So when they actually did the $1 trillion of sales of reverse repos, they also lowered the reserve ratio down to zero, allowing banks to have full access to their reserves, and that actually in and of itself increased the money supply, and the effect of this $1 trillion reverse repo should not theoretically negate the effect of market expansion activities of the Fed after COVID. However, this is around the time that people started discussing how the Fed policies can be inflationary. So the discussion can also be that the Fed may have noticed that the inflation is increasing, and that while they are arguing that it's transitory and it is because of the COVID, they may also realize that they have to lower the money expansion at some point in the near future. And again, this is your timeline, and this is where they actually did that article came. And if they notice that the transitory effect of inflation or transitory inflation may not be as transitory, and going from August all the way till January, a process review or policy review may have indicated that the Fed should have stopped or at least slowed down significantly with the money creation. So while they're arguing that this does not reduce deposit liabilities and so on, they may actually, their actual intention may be to slow down the money creation process. So, and I'm not sure why they would want to hide it, and I'm not saying that they do, but they're saying something that does not really make all that much sense. So, even though they've reduced the reserve requirements down to zero, you still have a very active and $1 trillion of active reverse repo process, which in a way is, in my opinion, now looking back, 2020 hindsight, was probably a preparation for that monetary policy change. So it was to slow down that money creation process, slow down the bank lending facilities, and then get ready for a non-transitory permanent inflation fight, and to get ready to start increasing interest rates. And I think, again, looking back, 2020 hindsight, I think this is the first steps of that policy change by Fed. So why they did this, in my opinion, I think that was to prepare for a monetary change, and that was the first indicators of Fed realizing that the inflation may not be transitory and the monetary expansion may have been overdone. And therefore, that was in a way to help the market create less money and perhaps prepare for a shrinking money supply. And how did they do it? Well, how they did it is right here. They actually sold $1 trillion of reverse repos, and that reduced the deposit liabilities, and the money supply is or supposed to shrink, because then there's less money for banks to lend, and if there's less lending, less creation, and so on and so forth. As always, if you have any questions, please give me a call and we can talk, or send me an email and I would be happy to answer your questions. So the third is, let's put this one as well on the chart. And this is on September the 14th, 2021. So we're looking at somewhere around right there, approximately. Yeah. So the question is, so Fed's record of failure with quantitative easing. Okay, so based on this article, how does Fed open market operations work? And based on this article, why does Fed resort to open market operations? And this is really interesting again, because now we actually see the last remnants of that monetary policy that Fed has been employing. And in fact, if you look at it, say, a longer period of time, going back to 2008 and 2007, this is the period of time that the Fed actually employed monetary quantitative easing policy. And recently as well, after COVID, by buying commercial paper or by buying US treasuries and intervening into the monetary markets directly, Fed also caused a very similar effect in the monetary supply as quantitative easing. So in this article, they argue how Fed has a record of failure with the quantitative easing, which, again, you may agree or not, but the idea is to answer these questions: how does the open market operations work, and why they actually do this? So, and the question is about the quantitative easing, right? So one of the ways that Fed actually does this, if you remember, the commercial paper funding facility, primary market corporate facility, secondary market corporate credit facility, municipal liquidity facility. So the Fed has been buying back US treasuries as well as corporate paper, as well as municipal credit and primary market credit and secondary market credit, and literally buying these assets into their own balance sheets and then leaving money in the market and creating liquidity, and therefore creating money to be deposited, which turns into loans, which turns into reserves, more loans, more credits, and therefore we have a monetary expansion process. So the quantitative easing, even though people argue that it actually failed, from 2007 on, our economy has been growing and there has been a tremendous success. So while the policy may be argued to be too aggressive and too unorthodox, it also can be argued that it worked. So the ends justify the means, perhaps. And again, so how does the open market operations work? Well, in this case, the open market operation intended with respect to this article is the quantitative easing or quantitative easing like facilities. So the quantitative easing specific 2007 all the way to 2016 and 17 with quantitative easing 1, 2, and 3. And then after COVID, their quantitative easing was not actually quantitative easing, but more with respect to commercial paper, with respect to bond buying, but not necessarily U.S. Treasuries buying. And that's how it actually worked. And through this, they lowered interest rates. They allowed corporations to borrow at zero interest rate. And we discussed this on Wednesday. One of the failing points of the quantitative easing was the Fed was hoping the financial institutions who now have access to zero interest would turn around and pass it on to the corporations and borrowers in the US. But some of that went international and some of that were just kept at excess reserves, and the banks were not as um, you know as efficient or as expectedly aggressive in lending the money in the economy because they simply didn't want to take risk when the interest rates were so low. And so the Fed probably felt that this quantitative easing did not serve its purpose and it took a longer time. But then, when Fed started to do exactly that, but instead of the US Treasuries buying corporate paper, they, just skipped intermediation, skipped commercial banks, and started funding the market directly through corporate papers and municipal papers and um, the borrowers directly, which again it took significantly shorter period of time compared to after post 2007, and it actually created a significant amount of money and perhaps was the reason for an overheating of the market. So why did the Fed resort to open market operations of such? Because I think, again, this is more of a what do you think question, right? So I think, in my opinion, I think that with the quantitative easing, the Fed realized that intermediation through commercial banks was slower and was not as efficient. And with the commercial paper and directly funding the market without the intermediating banks was faster and more efficient, and it allowed the interest rates go down to zero, and it allowed significant liquidity to be left in the market, and we actually have seen how fast this worked and how well this worked, so much so that the economy still kept growing, and in fact, it led to a significant inflation. So while again you can argue that this may be a policy error, but again the ends and the means, I think that it worked great. So I mean, if you look at the S&P 500, this is where the COVID started, and this is where we are. So there's a significant increase in the past 2 years after COVID, and not much similarities with other financial markets in the world. So something must have done right, and I think the Fed policies have worked. Um, I'm not arguing that there were shortcomings with this policy, but all in all, it was actually an effective policy, and it's impossible to time the market even for Fed perfectly, and I think by changing the reverse repo and then changing some of the monetary policies leading into the final decision to change from dovish to hawkish monetary policy was well timed. And now that we are coming to the realization that the inflation may be tamed, I think that more people will realize that the Fed handled this post-COVID era quite well. It's once in a century deal and unprecedented for our modern times. And the monetary policy for the COVID effect on the markets or economic pause, I think was quite effective. So please read the articles. I think that they're really interesting and they do provide significant point of view, a perspective. And looking back, I think it's easier than just going through more recent events because it takes time for these policies to be implemented and see results. But looking about a year before, I think is a lot better for learning for our learning objectives, simply because now we can see the results of those Fed monetary policy actions. So as always, thank you so much for working with me. I really appreciate your patience. And if you have any questions, please do let me know. And I hope to see you guys soon. Thank you. Bye for now.